Thank you, John. Thank you to Ninja Trader for sponsoring, and of course Trader Kingdom, which I've had a great relationship with for quite a few years. It's an honor to be back with you presenting here. I love the audience, love the interaction. If you've been in my presentations before, I do like to make them as interactive as possible. So I'll pause a couple times in the presentation to take questions. And as Josh mentioned, that's going to be on the, I think it's the left side of your chart. Just type in the chat box and I'll go through there as we progress. I don't just want to talk to you for an hour. I want to make this presentation we can both interact with. I'll ask some questions. How's your trading going? What's your experience with trend days, range days? Is this a brand new topic you've never heard of? All these things. I'll be so excited about doing that. So as we go through this, and I've been trading now since 2006 full-time. Before that, I was a swing trader on the bigger picture using fundamental analysis back in, I think 1999. So the big tech market bubble boom. That's when I got started as a hobby for fun and became really interested in technical analysis, which does the charts and does the integration of fundamental technical. About 2003, right there at the market bottom. And then became pretty much a technical purist from that point on. So we'll take a look at my experiences. But as we go through, and by the way, as an intraday trader, that's what Josh had mentioned, I like to combine the bigger picture, which is both fundamental analysis, why a stock is moving, earnings, Federal Reserve policy, interest rate, all those fun sort of big picture things with the intraday frame. So my intraday style of trading, if you're a member or have been a part of the membership or just seen the blog post, it does combine swing trading tactics on the intraday frame. So we're not hyper day traders, not trading 30, 40 times a day. It's really 2, 3, 4 times a day, capturing swings. And that's based on what I like to call day structure. And day structure does refer to trend days, which are my favorite. We'll see why. And range days. So let's take a look at these. All right. Trading involves risk. Goodness gracious, I wish that it didn't, don't we all? But it does. And so everything we do is based on probability, not based on certainty. There is no indicator. There is no strategy. There is no method, not Elliott fib, whatever you want to call it. It's not going to work 100%. It's set up the game plan. We talk about that each night. Set up your probabilities, know your key levels, have a dominant thesis, which is an expectation, and more importantly, perhaps, an alternate thesis, which is what should not happen. So again, Josh had a good job of covering the background, but a couple things on the CMT. That's a charter market technician. That's a lot of fun. It was really pretty much a grad school education, 2 years of reading every single book. And a couple questions on, I have a couple questions on the CMT later on. We'll talk about that. But it's what happened in my trading is I've come from a larger picture perspective. And when I went full time in 06 into 07, I thought I had to have everything, every indicator, every method, every strategy, etc. But as I went through that material, it sort of hurt my performance as a trader. Not so much the material was bad, it's just it was so much material to cover, and you don't need to know that. Trading success does not need to, or doesn't hinge upon deep level information. It just doesn't. Sometimes simple methods outperform complex methods, and especially that's good news if you are a new trader. Don't just jump in and get every single indicator, book, method, strategy that you can. The goal of trading is to figure out what works for you. Are you a short-term trader? Are you a larger-term trader? Do you like futures, ETFs, options, individual stocks, currencies, commodities? What's your preference? What's your time frame? And then what type of indicators, methods will you use? So don't just jump out and start doing everything. Focus on what's making sense. And especially if you're making profit as a trader, maximize what's working and try to stay away from what doesn't for you. There really isn't any bad or horrible things or great, wonderful. It's just what makes sense for you, the individual trader. And so for me, that's what's worked out. So it's day structure, trend day, range day. I'll recognize if it's a trend day and do certain behaviors, certain trades, certain strategies on a trend day that I will not do on a range day, and vice versa. Again, in the membership, we talk about this all the time. And the membership will just see that. It's one half educational, discussing the trade setups, and the other half is prediction, which is the game planning, which we'll talk about here. Now, jumping forward in the presentation. For trend days, when I work with clients, especially because that's a one-on-one coaching mentorship relationship, I get to hear what they're thinking, what they're doing, what their trades are, where their mistakes are, where their strengths are. And I'm able to build upon that. And it gives me a lot of perspective of where I was as a beginning trader, struggling trader, new trader, and how I've progressed and how they see they're progressing. And just common concerns, questions, statements, comments would be like this. In a trend day, which they don't typically occur every single day, they just don't, it's 3, 4, 5 times per month, they typically, or a trader will typically lose money because they hone their strategies. They like to fade the market. Market goes up, they want to short sell it. Market goes down, they want to buy it. Perfectly fine. But in a trend day, that doesn't work. And we'll talk about why that doesn't work. And of course, the indicators, Bollinger Bands, divergences, internals, momentum, just whatever RSI, stochastic, they're going to have you fighting the trend day. Those RSI, stochastics, Bollinger Bands, whatever, are going to say take your profits and maybe even short sell when the market, as you're seeing here, I can sort of draw this, goes up, 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 up. So Bollinger's not really working, right? Because it's just inching its way on. And of course, there's your, I should be buying here, I should be buying here, and it's not working. So we'll talk about this. And the famous one, price can't go any higher after such a large opening gap. This is a big opening gap. And that's actually a big opening gap to the downside. So price can't go any lower, right? No, it actually can and does. So let's talk about these things, set them up, and I think more importantly, discuss how we determine. So in the past, I've discussed these individually, trend day, range day, but I've talked about the strategies, methods, indicators, how to trade these things. Today, I'm going to pull the perspective back and look specifically at what these are, why they're important, and I think more importantly for you, how to determine what is going to happen the rest of the session. Again, based on probabilities, wish or certainties. So a trend day, just by definition, we'll start there because I think they're more interesting than a range day. Definition is that it typically begins with an opening gap. So factor 1, opening gap. Factor 2 is going to, well, in conclusion, definition here, open at one extreme, close at the other. We're going to see typically higher volume. If you look at internals like breadth or tick or whatever else you look at, the indicators will be higher, they'll be spiking. You'll visually see pickups in indicators like that. And often has higher volume, as you're seeing here. And the characteristic, the hallmark, which is how we build our trades, is that it's going to bounce up off of rising moving averages. That's a trend day. Another example, this is gold, a few months back here. Opening gap, this is 5-minute chart of gold futures. Same thing, opens at one extreme, closes at the other. Big relative opening gap. Not really seeing volume, but volume would do that. Indicators momentum making new highs and bouncing up off of rising averages. So we'll just keep that in mind as a simple definition for a trend day. Just one more time. Opens at one extreme, closes at the other. Typically higher internals, volume, momentum, and will bounce up off of rising averages. And why does it trend all day? I think this is more important. It's kind of a more theoretical, academic, what's going on. But trust me, working with clients and working even in my own sort of struggle with this years ago, the point is that we can't visualize, we can't see how far a market's going to go. And especially if a market's up 2%, if Apple or gold or oil or the S&P, if it's at 1.5% 2 hours into the trading session, it's just really difficult to visualize how higher or how lower that can go. So think about this, sort of study this, why this happens. It's the logic behind trend days and what makes them work. And Mike asked real quick, is there a size of the gap that is meaningful? We'll talk about gaps a little bit later, but that may sort of revolve around ATR, or average true range, or what a typical gap is. So futures have different gap profiles than individual stocks. So whatever that you trade, look at ATR, which is average true range, on a daily basis or intraday basis, and usually go from that. But it's relative. In high volatility environments, you're going to have larger gaps relatively, and low volatility, you'll have smaller. But we'll touch on that later. Good question, though. So a trend day typically is going to propel itself forward. Let's take a look at the top right side of the chart here, right here. We'll look at the words. This is the kind of how to visualize it. So what happens is a range, we call this efficient behavior. Price is up, down, up, down, up. That's in a trading range, nothing special. But then eventually price gaps up. It gaps up away from that range. And what typically happens at that point and the market gaps higher, what do you have to do next? Think about what happens. When you're a short seller, if the market gaps up against you, you've got to buy. You got to get out. Otherwise, you'll take losses. And to the extent the market goes higher, 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 you'll take larger losses. So the bears or short sellers initially help propel the market higher or lower in the case of a downtrend day. So when this is going up, you're having two factors coming together at the same time. Buyers or the bulls, they want the market to go up. They're making profit when the market does go up. They're buying, or they're maybe adding to existing positions. If you're a bear or a short seller, you're also buying. You're not happy, you're quite angry, but you're still buying the market. And so the market goes up, we'll tweet about it, we get up on Twitter, StockTwits, whatever, we'll do message boards or Facebook or whatever, we communicate with each other, and we'll say, oh, look, Netflix is jumping up today. I'm going to go ahead and buy Netflix. Well, that creates more buying, which creates more short sellers coming out, which creates more buying ad nauseum. And to the extent that this dual, we call this dual factor, or it's really just in a disequilibrium, it's a feedback loop. We call this feedback loop. So when the buyers are buying, short sellers are also buying. That's disequilibrium. It's directional movement, and those who fight the trend, if you're short selling a big trend day up, you actually will contribute to it keeping going. So that's why a lot of people lose money on trend days. They try to short sell the thing all the way up, and they're actually helping it go higher when they stop out. A couple of just visual examples, like a couple of months ago. So there's your upside opening gap, ES futures. Again, just definitions. One extreme to the other. You can't see that in hindsight, or in real time, but that's the definition. You're going to bounce up off the averages, and these actually are trades. We won't talk trading strategy today, but just as a future reference, this is how you would trade trend days, is doing so on pullbacks or breakouts, either one. So just, again, definitions for today. All right, so flip the script. Oh yeah, what average do I use? On all the charts, I'm just being simple here, but I'll use the and the 50 exponential. It's going to be blue. And I use a 5-minute chart. So I'll trade off the 5-minute chart just for reference. I will drop to a 1 minute if this thing is just really, really going, and I can't see the pullback to the 20. I might want to just take it, which is going to be a rare, super, super powerful trend day. I may drop 1 minute chart. Otherwise, I'm on the 5-minute chart and using, again, the 20 and the 50. And that's consistent through all the trades and charts that I do. Let's flip the script. So one of my clients, I love this. I never thought about this, but we were talking a couple of years ago, and he said, I hate range days. And I was teaching him these concepts. I do so poorly on range days. So what's going on? He insisted upon not calling them range days, but rage days. So think of that, rage. It's when the market doesn't do anything. Just up, down, up, down, up, down. Depends on what you like. Some traders don't prefer the trending. It just feels uncomfortable. Others like the range. So it's again, there's no secret to success. There's no indicator strategy method. If you like range days, focus your attention on trading range days. Trend days aren't going to be the thing for you, and of course vice versa. Again, flipping the script. If a trend takes place with buyers buying and bears buying, what happens with a range day? It's the opposite. We call it not a positive, which means positive doesn't mean up or down. It just means buyers begat buyers begat buyers begat buyers, or higher prices begat higher prices. Higher prices cause higher prices, etc. So negative doesn't mean down. It just means cross-checking. So if the market goes up, the sellers or the buyers take their profits at a trend line, and then the short sellers come in. So at this point, buyers are taking profits, and sellers are initiating short positions. At a low level, same thing, that it flips. And now short sellers take profits, and then buyers initiate positions. So it's a cross check. So lower prices beget, or they cause, buying. Higher prices cause selling. So we would use fade style strategies, which is more common. When you're trading and learning, this is typically what you're taught and typically what you start with. It's called fade. If the market goes up, you want to short sell it. And if it goes down, but particularly to a support level, you want to buy it. And to the extent that this continues, we would define this as a range day. Range day. So there's nobody winning. Bears are not winning. Bulls are not winning. It's just equilibrium. So we'll look specifically at these, but nothing is abnormal. Nothing is unusual on a range day. We'll see how things are, what that means, but we'll just kind of define this later on specifically. But no gap, no volume, little volume actually, news, nothing, and the volume is at or below the recent average. Again, that's relative to your market. Little terms that we use, this is in the trading course book, but also just in general. In a range environment, we're going to use these terms: upper resistance, lower support, and I think more importantly, central value. You've always heard resistance and support. You might not have heard central value as much. It's just a midpoint between the two, and it's a reference point. Price typically departs from upper resistance down to lower support, and from support up to resistance. And you don't really need anything but trend lines. Draw this yourself. So that's how we define if a range day is, or a trend day, is going to be a gap to a gap with extreme movement, moving averages. A range day will be typically no gap or very small gap, and bouncing between averages, which you can draw this in resistance, support, value. So Gary asked, how much lower than average volume? 10%, 20%? And how does this determine? I have a spreadsheet, which I don't really show publicly, but I have a spreadsheet in Excel that takes every 15-minute interval of SPY data, which is your S&P 500 ETF. It can be anything, but I just have always used that over the last few years. And so picture every 15 minutes, it's going to tell you what the volume of the last 10 days, or 15, depending on what you want to look at. I look at 10. So it's going to take the 10 first 15-minute candles or sessions or measurements, and then do that throughout the rest of the day. And so I just have a color-coded thing. If it's at or near the average, nothing's out of the ordinary. But if I'm seeing the volume for the first 15 minutes much higher today, so today's volume is much higher relative to the last 10 15-minute sessions, that's, or 15 minutes, yeah, 15 minutes, the first 15 minutes of the last 10 days, I look at that indicator. But you can do it yourself. You can just visually see it. It's going to pop off the chart. We don't want to be too technical or too detailed. Just look at the chart. So 20%, 10%. It's just what I do the last 10 days. And of course, that will help you in a low volatility. Mid 2015 was a very low volatility environment. So a 5%, 10% move was different than what happened in August, October, and really currently, where we're in a relatively higher environment for volatility in terms of the market going down, retesting the lows, coming back up, back to retest the lows, and etc. Before that volatility happened, the S&P was really in a tight range for the first 6 months of 2015. So it does depend. That's why you take a kind of a closer look, 10, 15 days on that. One more time, just color-coded. Upper resistance, your opening high. Lower support. I like to use candles, by the way. You don't have to, but I like to use the... what you want to see, by the way, is wicks or shadows, little things on the candles, at these support zones. And they are zones. They aren't precise 138.63. That doesn't make any sense. It's just a range of, say, 20, 30 cents or 2, 3 points in the ES, maybe 1.52 points. Same thing. So don't think of things as absolutes. It must be this or no more. It's a zone where sellers take their attack or they short sell, and buyers take their profits. So that's going to be range day. Bollinger Bands, if you don't want to look at trend lines, the other way to look at it using an indicator is just your typical Bollinger Bands. Nothing special. When the market, see there's no gap, right? Gap, this is yesterday's close into today, 20 cent, 15 cent, but it just jammed up within the first 5 minutes. Anyway, and so the upper Bollinger, lower Bollinger, upper Bollinger, lower Bollinger, kind of rides it down to the lower Bollinger, and there's your lower support, upper resistance, and we can draw that central midpoint. It's a range name. All right, so this is what we're here for. Let's do it. We got the definitions behind, theoretics behind us. Let's get on to it. How do we do this? Any questions so far before the this part? Just type them and I'll let me know. Jump ahead here. So we're going to determine a range versus trend. I've already hinted at it, but let's do that. Let's do this. Start with the assumption. If you're a detective, you're Sherlock Holmes. Today is going to be a range day. So just in terms of a detective scientific method, this is the null hypothesis. It's a range day. We're going to wake up, it's a range day. And if something else happens, the market has to prove it. Prove it to me that it will be a trend day. So your neutral bias, because it's just probabilistically, and there's more range days than trend days, assume it's going to be range day. So we're going to look at specifics as news, gap, impulse, volume, momentum, a jobs report, Fed day, things like that. You're going to make note. I do it with paper. I actually have a journal. I journal quite frequently throughout the day, just write things down. It helps me keep myself kind of mentally focused. Just make note. What's going on? Anything happen? Did Chair Yellen say something? Did Google report earnings? What happened? Anything major out of the ordinary? Did something happen politically? Which we're going to have that happen next few months. So going through this, and we'll do more specifics on it, but this is kind of the money slide. This is your checklist. And you can customize this as need be to your own market, but I'm an ES-centric person, which is the S&P futures, and that's what I customize my material, my trading, my analysis to. So if you trade oil, if you trade gold or stocks or maybe currencies, you can do this on your own. And all these have trend days. All these markets have trend days or range days or some hybrid between. So just we'll individually look at these. The next 5 slides are these, so don't worry if you haven't got this copied down just yet. We'll go through them one by one. But just for reference, unusual activity, we'll see this a little bit later, is going to be tick, which is your the stocks that are ticking up minus those ticking down. And yeah, these are CST. I actually live here in Los Angeles. I'm now on Pacific time, but this is Central. For the East Coast, you would just customize this based on East, Central, Pacific, Mountain, etc., or Hawaii time, etc. So whatever your market is, it's going to be relative to your time frame or your time zone. So tick is the stocks or issues ticking up at the exact moment, minus those ticking down, minus those that are negative on the session. And each index has its own breadth and tick. Dow has tick. Dow has breadth. S&P, and I like to focus on S&P. Relative volume, we just talked about that. There's your 10-day rule. And keep jumping ahead. A 10-day rule. And then just volatility expansion, that's nothing special. You don't need an indicator for that. Just look at it. What's the price doing? Is it jumping up? Is it a really, really big 5-minute bar, really big 15-minute bar, 30-minute bar? Just something special. Just is it doing that? And that's what I refer to when I say unusual activity. It's internals, take a breath, volume, which is relative to the last 10 days, and just visual price movement. Yeah, a question on the DAX and Nikkei. I don't really trade those. I follow the DAX a little bit in terms of overnight, but I don't trade it. I like to, again, when you're looking at the comparison, 15-minute bars, 30-minute bars, and I keep it consistent with that. And you can trade on the 5. You're making an assessment. Again, this is all about assessment, not so much about trading tactics today, at least, but so you're going to judge based on objective, factual evidence. So that's what we're doing here. We're not making guesses. The market's either gapping or it's not. The market's either showing high volume or it isn't. There either is news or there's not news. There's no guess factor to it. A lot of times, if you're trying to do this on your own, there's a guess factor in terms of it's a range day. I think it's a range day. Maybe it's a range day. Maybe it's that. No, make it objective. Be consistent with that. This is a strategy and a method, and everything else comes from that. Right. So what you do, just think of it when you wake up. I'm assuming you're in the U.S., but you might not be. And so whatever, in terms of the U.S. market, if you're trading European markets, the same would apply, but not so much of these exact terminology, but assuming kind of a U.S. trader. So you wake up, maybe wake up, it's whatever time, 6, 5 o'clock, 4 o'clock, whatever, and you just, out of bed, look at what's going on. So what's happening? And the first thing you look at is pre-market, not pre-market, but overseas market, overnight market. For example, the DAX, Nikkei, etc. What's going on? And you have that information in front of you. If there's not a big move, once again, nothing unusual, no news, nothing happened overseas, the overseas futures, overnight futures, nothing happened, that's probably a range day. So the left side of the chart will always refer to a range day. The right side of the chart will refer to a trend day. And the opposite. So something happens. Super Mario Draghi decreased rates or increased quantitative easing, or Japan came out with a economic report. China had bad economic reports. They had worse than expected, etc. Something happened overseas. There is major news, and there is a change both in Nikkei or a DAX and also in the S&P. So there is a change in futures. Next up, this is about, I say, an hour before the market opened. Yeah, the question is, would the ES move overnight too? Absolutely. And so you're looking at both. You can do both. Sometimes there's relative strength, weakness, and they're going to correlate highly but not perfectly. So take a look at those in addition to the S&P. No harm in doing that, even if you trade S&Ps or Dow, NASDAQ, or Russell. Let's take a look at what happened. So same thing. This is more news-centric about the U.S. This is U.S. news specific. We're going to have it. We had it tomorrow, which is the April 1st, April Fool's Day. A jobs report comes out tomorrow. That will be a catalyst. Doesn't mean it will be, but it's a catalyst for a trend day. When something happens, jobs report, anything major pre-market housing report. If a major company like Apple or Netflix or Google, if they report earnings either the night before or pre-market, if something major happens, could be a trend day. And of course, visually, we mentioned it earlier, but this is an hour before the market opens in that zone. If the futures are clearly going to gap one way or the other, that is a catalyst for a trend day. And vice versa. Not a jobs report, not a Fed day, no pre-market report, no company that we really are watching like Google or Microsoft, those kind of things, they're not reporting. And we don't see a change in futures, probably a range day. We'll open the market. So once the market actually opens, so that's 3 bits of evidence. 1, 2, 3. When the market opens, you have 3 bits of evidence. If this is a big one, so again, this is all probability. It's a model. If there's not a gap, or if there is a gap that is filled quickly, particularly in the first hour, that would suggest a range day. If there's no major spike, remember, nothing unusual in terms of internals, tick, volume, momentum, no spike, and write this out. Do your own sort of page. If you email me, I'm happy to send this to you as well. Corey@afraidtotrade.com. But you can do this yourself. And in fact, the more you do it yourself, the better you get in terms of distinguishing these factors. It becomes second nature. When you learn it, of course, it's not, but it does make more sense as you go. So if nothing happens and there is not a gap, you're probably going to engage in range day fade tactics. If there is a gap, and that is relative, I used to do gap fade stats on the blog. I don't so much do that publicly anymore, but you do still keep those stats. What a average percent monthly gap, if you do all the days in a month, 20, 21 days, if of the gaps that occurred, what were the sizes? You just look at that. That's, of course, an objective measure. The gap is not filled. So a gap that occurs that is not filled, especially a big gap, not filled in the first hour, probably going to be a trend day. Don't fade a trend day. It's kind of the main idea. And you're going to see a visual spike, so it's clear. It's going to jump off the chart. Volume internals. Let's see. A gap, yeah, Mike says, it seems that a gap is a really big clue. So have you developed a specific criteria? Are you using pit open or close? Yeah, I don't like to look at overnight action. I want to specifically focus on the S&P is what I trade. So, and I look at the index itself. You can use the futures in terms of looking at the numbers and the movement, but making this determination, the gap is closed to open. That way you can kind of test it out and do back testing statistics and even recent statistics on it. And I do that through Excel. I use TradeStation, Excel, Ninja, eSignal doesn't matter. Just get your stats. You can back test it. Even pulling it into Excel, something as simple as today's open minus the close, or whatever the math winds up being, and then do averages of that. About internals, jump back a couple slides. A question about internals. The tick for internals, I'm going to look at what's called the TICK. It doesn't stand for anything, it's just tick. It's the number of stocks, let's say S&P 500, that are ticking up. So let's say 300 stocks just had a positive tick, and it's measured, rapidly, second by second, really. So if 300 stocks just had a uptick, they went up. Last change was an uptick, but 200 of those stocks in the S&P were down ticks. They went down the last tick. That's going to be a subtraction factor of 100. So tick would be positive 100. If you see a positive 500 tick, that means every single stock in the S&P is up, and that's clearly a abnormality. So you want to see that. Breadth is a little bit different. It's more stable. Breadth refers to stocks that are positive. So of the same thing, if 300 stocks are positive on the session, and then 200 S&P stocks are negative, that is your breadth. Breadth is far more stable and longer-term predictive, intraday that is, than tick. You're looking for spikes. You're looking for anomalies. You're looking for things that jump to new tick highs or new tick lows or new breadth highs, new breadth lows. And each sort of program is going to show this a little bit different. The same numbers, but they'll show them a little bit differently in the symbols. But it's basically tick and breadth are my two favorites. And they're relatively simple. Okay, so yeah, gap is a big deal. Yeah, gap is a big deal. So if the gap, now this is the first hour. So look where we are. We're at the first hour. So we've already we woke up and checked out what's going on, maybe on Bloomberg or our favorite news program, what's going on. And we look at the first hour before the market opens, have the opening gap, yes, no. And by the first hour, we're checking to see objectively what's happened. So in the first hour, did the gap fill? If so, could be a range day. If you don't see back to internals or volume, you can also use on balance volume, just whatever the volume indicators are, whatever you want to use, accumulation, distribution. Lots of ways to do the same thing. We just focus on the principle, not so much the deep level details on it. So volume, if it's visually not higher, internals not higher. So what's happening, what I mean by this, high and low, so the market opens here, and the first hour maybe does that. That's a high, that's a high, that's a high, and these are lows. Versus this price is trending, and there really isn't a boundary. You can't really point out highs and lows. Market kind of does something like that. There really aren't boundaries. So where do you draw that? It's a difference. It's just a visualization on price for that high and low trend line. And if you're following StockTwits or any kind of major message board, whatever you're looking at, blogs or membership sites, whatever you do, people aren't really excited if it's a range day. There's nothing to talk about. No Google, no jobs report, no chair Janet Yellen, no Fed day, nothing's happening. We're bored. Sometimes trading is boring. And on a boring day, it probably is going to be a range day. So we find things to amuse ourselves as traders, but that means it's probably going to be a range day. Versus, we just had recently, not to mention a Fed day. Fed day happened a couple of weeks ago, where the Fed said, okay, we're going to probably keep rates low for quite some time. And then Janet Yellen, just two days ago, reaffirmed that at a speech at an economics club in New York, and basically said, we're essentially, I'm paraphrasing her, not going to raise rates for quite some time because the economy can't handle it. Well, that sent the market surging higher for the next 3 days into today's session, actually. And that's a news-driven volume spike, internal spike, that was driven by essentially a reinterpretation. Market jumped up and people had to reassess what the chair said, which means we're going to keep rates low. We aren't going to raise them. That's really bullish for the stock market. And we went 3 or 4 days in a row straight to the upside. That is an attention, urgency, news. Not too long ago, we were talking about China. Europe was in trouble, and whatever's driving the market, it's going to be news-driven. And of course, that's the first hour. Of course, there's more excitement, more tweets, more blog posts when things are happening. That's what we live for as traders, volatility and motion. So now we're at noon. This is relative to your time frame, of course, at this spot, lunchtime, basically. And I take a break. So I'll trade the first couple of hours and just take a break. And part of that is looking back and judging what's happened. So when you assess from the kind of peak of the mountain here, looking backwards, what happened? Same thing, overnight, before the market opened, gap fill, yes, no. Can you draw the range? Or what's tick doing? What's internal? And by this time, halfway, you've got half the day done. So you look forward, given what's happened, 2, 3, 4 hours, depending when you stop that clock. And it's data-driven, it's evidence. So you can draw your trend lines. You can see the Bollinger Bands, the prices pivoting between them. And the prices maybe can totally contained in yesterday's trading range. So today's high and today's low, first 3 or 4 hours, might be totally within the range of yesterday. Probably going to stay within that range. Probably not going to magically trend out of it. And of course, visually, if price is just chopping through those moving averages, that's a range day. What happens on a trend day? Trend days, the price hits those averages and comes up off of them. When they're on a range day, they don't. They'll chop through them, so they don't really matter. So Bollinger Bands work well on, we'll see this in a little bit, but Bollinger Bands work well on range days. They're horrific on trend days. They will mess you up on trend days. Moving averages are do really well in terms of trading strategies on trend days. They'll also mess you up if you try to buy into a touch of an average, that is, on a range day. Don't close in the first hour on a trend day. Generally, a gap, let me jump back. A gap is expected not to close. Doesn't mean that if a gap fills, it can't be a trend day, but for the most part, probabilistically, a trend day is stronger in terms of probability of forecasting the rest of the session. If there is a gap, it's relatively large, and the gap after an hour, now you usually get a fill. So if this is yesterday's close, this is today's open, you do normally get a little pushback in the gap, and so that's the first hour, 30 minutes. But if the market doesn't fill that gap, it's quote-unquote predictive. And what that means is buyers are so strong that they couldn't even push the market back to where it closed. So a lot of people, especially when it takes out the high, the opening gap high, it's going to cause the bears to come out and cause the bulls to get in. And so that's what precipitates or causes or fuels a trend day. It's a gap that usually pushes down a little bit, but doesn't actually fill. Let's see. Sorry. Okay, good question. Sorry, I'm going too fast. We'll see this visually, so I'm kind of jumping ahead. We're seeing visually that a Bollinger Band will be quite well to help you in terms of short selling into the extreme. So short sell the upper Bollinger, buy the lower Bollinger on a range day, repeat behavior. It's not going to work on a trend day. You'll short sell the upper Bollinger and it keeps going, and you'll lose money. So that's not what you want to do. So Bollingers work best on range days. They work poorly on trend days. There are slides to kind of back this up, but just quickly. And moving averages are going to work well on trend days. Market's going to come back to the average. But on a range day, it's going to chop through it. So you can't use pullbacks to an average on a range day. It's not going to work. If you try to buy that, you'll lose money. So that's why I think a lot of traders have trouble, especially new traders, because they're taught, they buy a course, they read a book, whatever happens, and they say, buy pullbacks to averages, or short sell the upper Bollinger, or buy the lower, whatever they're told. And that's fine. Those things work. But indicators, methods, strategies do better in trending environments, for example, moving averages, and do really poorly in range, moving averages. So you'll see this as you kind of put this into practice in your own trading. So that's, and of course, prices bouncing off averages. You have a departure from yesterday's range. We call this riding. So what that means is price is hitting the upper Bollinger and keep going higher. It does not come away from the Bollinger. Or the opposite. If you're hitting the lower Bollinger, it keeps going down. We call that riding the Bollinger. In other words, we don't use Bollingers on trend days. All right. Okay, so a couple of examples to go through. This is kind of fulfilling out this time sequence checklist for a range day. So here is yesterday's, well, not quite the high and low, but it's a high and low of this end of the session. We're going to have an open. This is SPY down about 30 cents. Relatively speaking, that was not a lot of movement. Within the first hour, market jabbed up and filled that gap. and it filled it twice. Again, pretend we don't know the future. We don't know what's going to happen next. This is internals. This is tick, T-I-C-K. It did not. Now notice, the price made a new low. The tick did not make new lows relative to yesterday's close. That's not an extreme. That's not unusual. And so the price, again, bounced back up. So you can even draw a range in tick, which is a market internal. Back down we go. Up we go. Down. A little tiny range occurs here and up there. This is a range day. You would not be buying pullbacks because there are no pullbacks. Maybe look at Bollinger Bands. You can draw the hand-drawn trend lines, etc. Well, we're not talking strategies, but that's, again, just we're dissecting what causes these things and how to look at it. One more time. Yeah, there's one example. So again, pre-market, nothing happened. Open, there was a gap, small gap, filled in the first hour. No abnormal activity. And by lunchtime, this is about here, the market had done nothing. And in fact, it had traded within a range. So this is, if you're trying to predict out the future, what's more likely to happen? Is it more likely the market breaks a low and goes down, or more likely that it goes up? It's more likely that it goes up, which is exactly what happened. And then once it goes up, is it more likely to go through this or back down? So this is how you're predicting by probability. You're not making a forecast. You're just saying, given these factors, the market probably stays within its range, and you trade that. There are some higher time frame things that help us, and this is a little bit different. So we're going to do something different than what we just have been talking about. So we're going to the higher time frame, not the overnight, not the gap. What happened the night before? So as a member, this is exactly what we talk about in the planning report for the next trading session at the Diagnosing trades. We're looking at what happened today, what trades are available, and then what the expectations are for tomorrow. What levels, where the market might trade, if then, if above this, expect a big breakout because you're ranging, et cetera, et cetera, et cetera. So we do plan this for you. But the principle is this. Trend days will often emerge or spring from range days. The longer the range takes place, the greater the breakout. So this is just this is ES Futures, 15-minute chart for the example. There's a range, there's a breakout, gap, and the thing went all the way up. The next day was a range, and eventually broke out and trended all the way up. We stayed in a very lengthy range for about 4 sessions. And the market opened up with a downside gap. You think, oh, this can't go any lower. It's got to come back. And no, it doesn't. So it opened up down and just hit the floor. So it came all the way back down to the prior range, the midpoint. Anyway, so the point is, whatever today is, whatever happened the last couple of sessions, that can be a predictor for the future. So if you have 3 or 4 range days in a row, you better be on guard for a trend day. If you have a trend day, you probably aren't going to have 2 trend days in a row. That's not common. It is very, very uncommon to have 2 trend days in a row. Typically have alternation. Trend day equals range day. Range day equals trend day. So the higher time frame factor will kind of guide your thinking. Switching gears again. There's a big statement that I love to say. It's write this down big time. It's if something should happen, but doesn't happen, it often leads to a larger than expected move in the opposite direction. I'll say that more times, but if something should happen, but doesn't happen, it often leads to a larger than expected move in the opposite direction. So if the market's uptrending and then breaks a support level like that, odds favor or expectations or logic says after an extended rally, break of support, we probably go and retest out some lower levels. That's logical. And so people short sell and they take their profits and et cetera. But what happens if the market stabs them, sort of fades them or traps them? What happens is, once again, if it should go down but doesn't go down to say maybe this level here, it's going to go up and probably go up quite violently. So trend days, more than one, a series, we had a few of these not too long ago, trend days in a row, or just a trend day itself, can occur from a trap on the higher frame. So each example that I'm showing you resulted in a series of 1, 2, 3, 1, 2, 3, and then 1, 2, 2, 2, and then a series of trend days. So same thing. Market should have pulled back, didn't pull back. 1, 2, 3, and then eventually 4. So just repeat that. If something should happen but doesn't, it often leads to a bigger move in the opposite direction. Classic trap. So we just look up on the educational section, trap, bull trap, bear trap. That's what we're talking about. So we talked about this, but just textually, if yesterday was a big trend day, we favor a range day today. Yesterday was a trend day, especially a big trend day. We saw this just not too long ago. Odds favor a range day today. If there's an obvious, like S&P 2000, Dow 16,000, NASDAQ 4,000, etc., something really, really obvious. Support, resistance, level, target, prior high, prior low, big time, big picture, weekly chart even. We would probably see equilibrium. And once again, that means balance. Bulls and bears aren't willing to put the money in there to jam the market up and down. So for a little while at least, at a key inflection level, they'll form range days, maybe even a series of range days at a key level. So if you're at a key level, odds favor a range day at that level, at least initially. And this is another one for a range day. If we know that a Fed day or jobs report day, something really, really big, is taking place, you might see a range day ahead of that session. And that's just people, even quarterly options expiration. You might see the market rotate and balance. Think of it like that. A range day is a rotational balance day. At key levels before things, people hedge up. And by hedging, they're going to... All right, so once again, just driving the point home. Range days follow sudden price swings. That's a big move down. This kind of stayed in a range. Super move down. Super move back up. And then a range day. So that's an anomaly, probably a news-driven anomaly, where it was Greece, those sort of things, or overseas Europe, that there's a series of trend days, or maybe a trap even. But then typically you're going to have range days take place after big moves. So again, probabilistically, if you're in a range day, you may see an escape from the range. This is a reversal day. Otherwise, you might see a trend day. So trend day, if it goes above, maybe beneath, but look at the, it's called the rotational principle or the alternation principle, that a range evolves or devolves into a trend or emerges into a trend. A trend winds down into equilibrium. So again, higher time frame factors. This is the last few sessions. This is March, really the Fed day. Chair Yellen back a few weeks ago, March 16, 17, 18, and then to the 21st after the holiday. So we had a Fed day, which was, or not so much holiday weekend. A Fed day, chair says, yeah, we're pretty good to go. We're not going to raise rates. In fact, the economy is not that great. We're not going to raise rates, so that's bullish. And the market responded from a breakout of a range into a, this is not a trend day because it's a Fed day, but it gapped and closed at the highs. Next session kind of went down, pulled off that support level, and trended all the way up, bouncing up off your 20. Then the next day was, see, this is the opening of the session. The market closed here and opened at the same spot, went up a little bit. There was no gap, essentially. It kind of kept going higher, but then devolved into a range. The next session, clearly, this is March 21st, downside gap, fill the gap, and then pivot within a range. And eventually we broke out from that. But range day, trend day, Fed day. So again, markets will emerge into trend days if there is a reason to do so, or traders are trapped. Chair Yellen coming out and saying, yeah, the economy is not that great, so we're going to not so much boost production, but we're going to keep rates really low. Market loved to hear that, and the market surged to the upside. That was a news-driven catalyst, and those typically do precede Fed days. So a couple more things before we go. This is the concept of the bullish orientation. We talk about this in the lessons, but bullish orientation just means the 20-period exponential is up and rising away from the 50 exponential. And in that environment, not talking trading techniques, but you don't want to short sell. And the membership, we use the word illegal. If you short sell when the market's showing this picture, you've done an illegal thing. And what's going to happen to you? And the police don't come get you, but you're gonna lose money. Shorting here, shorting there, shorting. The market just keeps going up. So you might capture 1 or 2 points, but the bigger picture is, why don't you just buy this? Why don't you buy that? Et cetera, et cetera. You make your life a lot easier going with a trend than trying to find that elusive couple points against it. Yeah, definitely. If you want to email at Corey@afraidtotrade.com, asking about the slides, I'm happy to send those over. It's a lot better on that because you can look at them individually and kind of zoom in. And I typically do talk and go quickly to cover the material. So Corey@afraidtotrade.com, I'll be happy to send the slides over for you. And a couple things. So just one more look at this. Notice how the price came back to these rising averages and kept going up. Opened at this. This one is a little bit anomaly. It kind of filled the gap, gapped up, touched the gap, and then kept going up. So it's the same principle. Those who were short, maybe correctly so, they had to take their stop losses. And that's what propelled the market higher into a trend day. This is a Russell, by the way. The same moving averages, now, one more time, you're going to buy pullbacks to rising averages. You're going to use the moving average as a buy point. On a range day, notice there is no gap whatsoever. Market comes up to the prior high, fails, comes down to low, and then eventually forms a range throughout the session. If you use moving averages to trade pullbacks into, it's not going to work. So you short sell this. That didn't work. It comes back up. You buy this. Kind of worked, but not really. It kind of went down. Same thing. So shorting, it's not. So the principle is, on a trend day, look to your averages. On a range day, don't look at your averages. So that's one thing that kind of hurts people too. Yeah, so same thing. A trend day, this is one that gaps up, kind of almost fill the gap. This is back to the SPY. Then trade number 2, and eventually trade number 3. All those are pivoted off the 20 moving average. And if you did anything else, you lost money. And maybe a short sold there, but come on, really? Make your life easier. Buy pullbacks on trend days. All right, almost done. So this is the easy reference diagram, and concluding it. It just means range day. These are your factors. What happened overnight? Nothing. Open, no gap. First hour, fills a range. Nothing out of the ordinary. Morning session, you look backwards. It's been a range all day. What's the future going to be? Probably a range, which is what happened. On the trend day, this is tick, which is showing an anomaly. So tick and price are gapping up to new highs. You're seeing strong tick, strong volume, and a gap that doesn't fill. And you're going to look at that. You have, once you got that first hour, you have that first initial. This is a range, up, down. There isn't a range. It's straight up. Maybe it pushes back in the gap, but it goes up. And so the first hour observation, what's the future? It's probably going to keep going up. So if it's going up all day, you're half the day's done. What's your prediction? Odds favor, doesn't guarantee, but probably means it's going to keep going up. Now, that's why I focus in the morning to trade. The afternoon session may kind of flatline. And in fact, the afternoon session may reverse. So this is a failed trend day, or we call it a rounded reversal. That's when tick, momentum, volume, they may be strong in the morning session, but they fail to confirm. They visually diverge. Or the price breaks the moving average, or things happen that shouldn't happen, and that typically leads to a reversal. So just because it is a trend day doesn't mean it will always be a trend day. A range day can break into a breakout mode. More times than not, they don't. But just be aware, don't just blindly buy the pullbacks. Look at your internals. Are they confirming, which is making a new high with price? That's a confirmation. Or are they disconfirming, which is they are diverging? It's not another way to look at it. Trend day. Can we also use the 10-day moving average, not the 20? Absolutely. Absolutely, perfectly fine. There's no secret to it. I like to go to the 1 minute chart. So if I'm trading a super strong trend day, my solution to get into trades that I might otherwise miss if there isn't a pullback is not to go to you can do this, nothing wrong with it. But my personal preference is not to pop a lower or a smaller, shorter average. It's to go from the 5 minute chart to the 1 minute chart. That way you're going to see a different moving average. You're going to see things a little bit clearer on the pullbacks, maybe shallower. But you can do that, nothing wrong with it. But I'd maybe look at the 1 minute chart. But certainly drop to a 10, that'd be fine too. Does GAN work to predict future market moves? I've been trained in GAN. It's helpful, so is Fibonacci. It depends on how deep you go with GAN. Price, what GAN, if you're not familiar, is typically the concept, it's WD GAN. It's price equals time. So for example, I guess what your quick 5-second version. If the market's been in a trading range for this amount of time, it probably will pivot up. I think this is it's not perfect, but if this is like a circle, like a radius, that's a radius, draw it up. It probably does a breakout and goes up to this radius target. So if you kind of think about it, this is how long it's been going. How long it goes that way will come up to it in price and time. Again, that's more advanced than this. Where can I get a version of GAN that's understandable in English? Do you have one I can? No, I don't teach. I don't teach GAN. I sparingly use GAN. I use it for projection levels. I'm not a GAN trader. I will use it from time to time, but I don't have a course in GAN. I'm not a licensed GAN person. I don't really. I've done the courses in it and been mentored by someone that did teach deep level GAN material. I found it didn't work for me. But that's, again, if it works for you, people do have success with it, but it's beyond the scope of this presentation. Have I used Renko bars? No, I've not used. I'm an old school, so if you find it, I'm pretty much an old school classic technician, meaning Charles Dow. I like to look at price. Particularly, I'm trained in the Schabacker, Edwards, and McGee. I like to think that Wyckoff. I'm a huge Wyckoff proponent, which is Richard Wyckoff. I use some teaching from GAN, some teaching from Elliott, accumulation distribution, but I'm more traditional, so I'm not going to be kind of modern day stuff. It's the principles. The principle thought is principles have worked this long. Focus on which ones still work or still apply to today's market, and go with history. Go with the success. Build on success. Don't try to reinvent the wheel. Is my approach. Yeah, Jim, do I trade supply and demand? Goodness gracious, yes. Everything I do is supply and demand. So I'm not, in my methods and the membership and what I teach, I don't, with the clients and mentorship and coaching, I'd have nothing that's special. I have nothing that's going to say, this is Corey's method, it's going to be special. It's a combination of supply demand tactics, which gets to the core of what moves the market. That's supply demand differential, nothing else. It's not GAN, it's not Fibonacci. It's people responding to these things that create movement. Trending movement is one side of the market essentially being screwed, which leads to a big trend move, and I'll trade that. Otherwise, it's in a range. So accumulation, distribution, divergences, strength and momentum, confirmation, non-confirmation, all these things really are Charles Dow principles. Back in Dow theory, and Elliott has a little bit done some things with it, and Gann's done stuff with it. Of course, Wyckoff has made it more professional, and so I'm just a long line of people that have been doing this for years. Linda Raschke was my mentor, so it's her method similar. You're building upon the shoulders of giants in the technical trading community, and this applying it to today's markets, which are very, very different. Of course, they're very different than Gann and Elliott and Dow. It's high frequency stuff, but these things still work. But it's supply demand. Yeah, supply demand. Yeah, we'll talk about this in a little bit. All right, 1 second. So the realness of the Corey. It is understandable, and this is my 9th year professionally doing this, 15th, 16th year, God, goodness gracious, as an investor / swing trader / intraday, but 9 years professional, meaning every single day doing this, intraday level. I get it. I understand. This is hard. Trend days, it's very difficult to project or think or visualize how far the price can go. And I think it goes back to just doing it, working with a coach, reading material, just having your experiences with trend days, and visualize how far, and they can go really far. An S&P that's down 2% can end the day down 4%, and vice versa. So don't just think it's down 2. It can't go down any further. It can, and obviously sometimes it does. Once again, be a detective. Assume that it will be a range day until the market proves It's got evidence, data, facts, not conjecture, not guesses. That it will be a breakout trend day. And the questions a minute ago for reversals like today, we had a consolidation in the morning, which we did after a big move. So we expected a consolidation day. But price dropped down real hard and it came right back. So that was a breakdown that pushed it right back to not so much the close. If you think of today's session, it was range, gap, and reverse back up. So just keep in mind that as you're doing this, I'm showing for educational purposes textbook examples. In the real world, things like that happen. It's a range as some news event happens, somebody says something, somebody does something, whatever, market lurches lower, then maybe reverses. Or if it's a trend day, it's going up and somebody says the opposite. Oh, it's going to, so there isn't, this is always what it's going to be. It's all probability. It's all checklist. It's all objective. There's no guessing. And so we look at things that if there's a failed trend day, we have a metric for that. It typically breaks under the 50-period moving average. That's something that shouldn't happen. And if it does, that's a metric that says stop trading with the trend. If the market has a clear range like today and then breaks out of it, well, we don't want to start buying, we don't want to start buying all the way down. That's a departure from the norm. Anyway, for my metrics and my methods and monthly profits, don't judge yourself day by day. Judge yourself, I would say, monthly, especially if you're new. Weekly at best, because some days are going to be bad. Some days just won't give you any opportunities whatsoever. You can be the best trader in the world, and the market doesn't do anything, and you won't make money. You can't beat yourself up about that. So my biggest profits of the month come from trend days. So I won't talk strategy, but I do the best trading on typically higher leverage with more focused attention and more efficiently, just buying pullbacks during trend days. So I typically will have consistent profits a few, 3, 4, 5 days out of the month. Otherwise, you're fighting and struggling and working harder and doing this and that on range days, and it's not that much profit. So you need to make the best, and we can talk about it a little more. But take advantage of trend days, and bump up your profits, your account on those, and don't just think every day has to be the same. Another fatal error, not so much fatal, but trading error is if it's a trend day and you normally take in $500 a day or $1,000 a day on average, and you stop your account you make $1,000 and you're done. It's 9 o'clock or 10 o'clock, and you're like, yeah, I got my profit goal, and the thing keeps going. And you could have had $3,000 that day. So that's a difference of you came out of the market with $1,000, which is maybe what you do on average, or whatever your account size is. But you could have had the $3,000 if you kept trading or understood the trend day principle and did that. So just getting kind of complex here. But just think about that. Trend days are very, very efficient. You can make a lot of money quickly, or you can lose a lot quickly if you get caught up on the wrong side of a move. Typically, trend days, the question is how many trend days can we expect? In volatile markets, more, and less volatile markets, less. But on average, I've done the research for years and years now. I keep an Excel file with it. I would say on average 4 to 6, depends, in terms of ES trend days. Individual stocks will have more or less, but typically 4 to 6 is going to be, there's 20 trading days out of the month. So in volatile environments, you might get up to 10, which is about half. That's really rare, really rare, but it can happen. But 2 and 3 is very rare. 4 to 6 is typically your little sweet spot. So have your, and again, slides, Corey@afraidtotrade.com, and just go through. Write out your own. I will be happy to email you if you want, but I think you're going to benefit if you just take the chart and kind of go make your own checklist and go through. It's an EY, so Corey@afraidtotrade.com. The blog is free. It's open to everybody. I've been doing this since 2007, so almost 10 years of that now at afraidtotrade.com. I still do the commentary, stock scans, education, lessons, and just what I'm looking at, just kind of random stuff, but things that help you, hopefully help you at least. The premium is more specified. It is the daily planning, education, real world. So we talk trend day, what it was, what set it up, what were the trades, what did you use, what went wrong, what went right. And then I think more importantly, that's important too, we'll set the next day up. So a lot of services will set the next day up where they'll talk about, here's what to expect. I'm not a Fibonacci person, but I will at times, if needed, use them. So I'm definitely not going to try, at least, not to be biased, bull or bear, and indicator blindness. I will do the best through my education experiences to give you objective, actionable research, and of course, planning. But more than that, we're going to talk about lessons. So what happened? Why was this a good trade? Did this trade fail? What went wrong? And do also some psychology stuff. So it's kind of a dual thing that other programs don't offer. Education plus planning. And that is, as Joshua mentioned, it's afraidtotrade.com or afraidtotrade.leadpages.net, a little special thing. Happy to send that over to you too. All right, so a couple of questions before we go out. Jim says, I really like the range versus trend concept when entering the morning session. And answer some questions. Okay, cool. What's the question? But yeah, thank you. Yeah, definitely. Me too. And honestly, when you start trading, kind of a quick little comment. You have so much to look at. You've got StockTwits, you've got Twitter. If you look at that, you've got other blogs, you've got CNBC, you've got Bloomberg. The list. I mean, it's dozens upon dozens of sources, and you get caught up in this. What's going on? What's happening? Up day, down day. This gives you structure. This gives you a plan. It is objective, and in my experience, doing things objectively, meaning not guessing. Will you be a buyer today? Will you expect a high volatility or low volatility session? And if what you expect actually happens, that's really cool. It feels good, but also you can make profit off of that. Otherwise, if you don't know, you just walk up and start trading. Good luck. Does a trend almost always begin overseas? Not so much. I've had days that you always look at overnight session, especially the futures market when you wake up. But I've had days that the market will open up flat or not really within the first hour. That's when we have that metric of the first hour. Because nothing may happen overseas, but the jobs report, you watch tomorrow. The jobs report may surprise the market. And if it does, it's going to emerge not before, but after. And that happens right before the market opens, about an hour before, 8:30 Eastern, 7:30 Central. It's going to be when the actual jobs report takes place. And you can have a trend day emerge from that, and that won't show up overnight. Given the name of the site, am I also trading on fear and trading? Yeah, Afraid to Trade was interesting. I didn't realize it would go this big back when I first started. I was trading full time, and I was sometimes bored or looking for things to make myself manage trades or stay in trades longer, connect with people at the Traders Expo, etc. I started blogging and just putting my trades out there, what I've learned, and just kind of keeping connections. And I chose to call it Afraid to Trade because my story, it's kind of that. I think it's common to have a initial success blowout, which I had, and you kind of either one of two things. You quit and go away, or you realize, hey, I can make a bunch of money doing this, and you go back to the drawing board and really learn how to do this. That's my story. It's on the page too. It's common. Just do well initially, blow out, get scared, and eventually come back. So it's just a cute little name, but I don't talk as much about psychology as I used to. I'm shifted more towards analysis and education about the market, about trading tactics. I don't so much do psychology, even though I have a degree in psychology. This is my preference. I think it's, to me, is more fun, markets. And psychology, markets are always changing. Psychology doesn't. Here's how you overcome fear. Here's how you get yourself to put on more size. Here's how to overcome hesitation. That's a fact. It doesn't really change. You just learn the material, learn the methods, and then that's it. You keep doing it. But the market, you have to keep every single day is different, and to me, that's much more fun. But there's a big page on overcoming fear. There's things that are there on the website, certainly. Yeah, definitely. But I focused over the last 9 years because I felt like there's not much to say in terms of that. Yeah, I've written it all, not written it all. There's always, markets are always changing, news is always changing, patterns, new things are coming online, etc. Yeah, Jim says, I can't tell you how many trades have gone wrong from letting the winners run. I'm not sure exactly what I mean. I can't tell you how many trades have gone wrong from letting winners run. Well, in general, I mean, just to be general knowledge, general concept, a lot of times, and I fall victim to it too, if a trade has this much potential profit, if it's a breakout trade, it's a large target, large movement trade based on some type of breakout maneuver, and the market eventually goes from, it could be a swing trade, by the way, goes from here to here. And so you enter, a little bit higher in the breakout, and maybe you get scared on a pullback and you exit there. So this is part of what I do in the membership too, is we call this efficiency training. And with mentors and clients, I do this too. It's efficiency training. So your entry was here, your exit was there. You basically got, which is the psychology side of it, really, keeping it to the program. Here's your target. Here's your stop. There wasn't any way to get out. There wasn't. Why would you do that? Well, I got scared. Okay, well, whatever. It happens. It happens to all of us. But to go back and look at what's called efficiency, you could have gotten this. So we train on that and say, this is what you actually got. This is if the strategy, if we would have followed the strategy, you could have got this. And what's maybe got about what we call 50% efficiency, or halfway of what the actual trade was, or whatever it winds up being. Or the opposite, if the market it goes up initially and we should be stopped out for a small loss, we're like, oh, it's going to come back, and then we should be stopped out here and stopped out there. And next thing you know, a little tiny thing that was just a normal, and the market should have gone here, but it didn't. It's you just psychologically messed up. So you have a bigger loss than you expected. So that's kind of the danger for trading, which is taking smaller profits than your method allows you, trend days particularly, or taking larger losses than your method allows you. Trust me, use stops. Oh, goodness gracious, use stops. Don't play games. If you're losing in a position, don't play. Take your stop and move on to the next trade. Again, judge yourself based on weekly, if not monthly only, performance in your account. And don't hate yourself if something goes wrong. If you take 2 stops in a row, might not be your fault. It may just be the market is rangy, volatile, doing something weird, and if that's happening, probably most of us aren't making money because it's a strange noise market on that. Hey, Tom said, that's my goal soon, the bigger win. Yeah, totally. It's just practice. Definitely practice getting doing end-of-day analysis and do this efficiency thing, which this tells you. If you come out with it, that's something too. If you come out with a profit, you're like, yay, I made $500. But if you could have made 1,000, it kind of it's right. You don't feel as bad. You don't feel as like negative than if you lost 500. So just in terms of professional trading, your goal is, you won't say this as a new trader, but as a professional trader, this stuff is going to make or break you. The stuff that you could have had that you didn't versus what you just stopped out on. Can watching the NQ and TF and YM replace tick? No, not really. Let me show you why. And by the way, those are TF, which is Russell, YM's the Dow, and NQ's the NASDAQ. So let me show, where to go? In terms of the tick, no, because they're different. Well, I'll show the slides there. The tick is a market internal indicator. And so let me show, where to go? Yeah, okay, yeah. So the tick is a market internal indicator. It's not based on price. So looking at the YM, the Russell, the NASDAQ, they're all price. They're all the market itself. They may be a little bit different, but the tick it's not based on price whatsoever. That's why I like it. That's why I need to use it, because it is based on the market. So how many stocks are ticking up minus those ticking down, and breadth is similar. So you do want to use that, and you can't really replace it. You don't have to use tick, but breadth would be market internal, advancing stocks minus declining stocks. But use something, because this is a generated, or moving averages, Bollingers, momentum, RSI, stochastic, the list goes on, Fibonacci for that matter. They're all based on price. So they have a little bit of a lag to them, but market internals aren't. Market internals are based on the market. It's like a tree. Look at a tree. It looks really strong, but look inside of it and it's rotten to the core. So or if it looks weak on the outside, really inside it's strong. It's just the market internals are going to look beneath the market. So no, there's really no replacement for it, especially not some of the price. Patterns today are different from what they were 50 years ago. Oh, yes. That was from Karen. Yes. In terms of pattern differential, I studied initially in, I guess, 6, 7, 8 with Schabacker. And by the way, it's a book that very few people talk about or see or hear. It's Schabacker, and then he bases his S-H-A-B-A-C-K-E-R. It's making money in the stock market or profiting from the stock market. It's a really weird name, but it's Schabacker, Richard Schabacker. Also, Edwards and McGee. It's probably your seminal book that you have to read for the CMT. It's Edwards and McGee is his market. I forget the exact name, but it's a great big book. Thomas Bulkowski is kind of a modern pattern person. He's got also some really big books. He's a great analyst too, but you can compare the patterns. And the patterns, what I mean by that is triangle. It's simple stuff like triangles, rectangles, diamonds, head and shoulders, double top, that's kind of stuff. I think more so now because the patterns are people know about them. they're more likely than not to fail in a sense, but maybe they were back then. And computers, you can scan. You can go to finviz.com or name your program for that matter, and just scan for patterns. Show me a double top. All right, cool. Here's 44 stocks have a double top, and you couldn't do that back then. So there's certainly influences there, and you can be more aware. I guess the main idea, real quick, is be more aware and on guard for failure patterns, which is, say, a double top comes down, then jumps back up. So be on guard more for failure outcomes. Oh yeah, Richard Schabacker, S-C-A, I'm just making it, I can't exactly, but S-C-H-A-B-A-C-K-E-R or something like that. It's technical analysis of stock market profits or something weird like that, but it's a name you wouldn't think of. It's kind of McGee, Edwards and McGee, M-C-G-E-E. Amazon, stockcharts.com, anything that's going to have those. Edwards and McGee, I think back in the 40s, 50s. Schabacker was back in the 20s. He's really not really known very well, but was kind of a precursor. Of course, Charles Dow, Richard Rhea, R-H-E. Look at the original Elliott, Ralph Elliott. Yeah, just keep going from that. Yeah, we're going to conclude with the recording. Josh mentioned about that about the recording. They'll send an email tomorrow. They do a great job of that. But thank you for attending and for the questions and answers. It was wonderful here. I always love the trade station, the Trader Kingdom and the Ninja Trader audience and the attendees. So thank you for your questions, your attendance, and your attention. So be safe, be careful. We'll turn back to Josh and hope to see y'all soon.